Welcome back, everybody. Derek Sue, your East Oakland advocate. Hey, do you hate your bank? I know I sure hate banks in general. And for a time, uh, I had a way to not use a bank except for my money. But I had the Bank of Me. And so I'm going to talk about how you can create the Bank of Me. And when you need a loan, you loan or you borrow from yourself. And I'm going to show you and tell you exactly how to do that. And this is part two of my estate planning. And the reason why I encourage folks of all ages, no matter how young or how old you are, you can never start too soon. And the vehicle that I'm specifically talking about is whole life insurance. And I want to talk about the importance of it. And in the beginning, as a first-time home owner, I I did have term life insurance, and uh, things didn't work out in that instance, and uh, there are a lot of limits to what term life insurance can offer you. And then when I got into my second home, I didn't have any life insurance at all for a number of years. I was just working my butt off trying to reestablish myself and then also move further along in my life and get past the bankruptcy and put myself in a position so that I could purchase a home again, which is what I ended up doing. And once I purchased that home, I purchased, moved up, and then again, uh, we moved up in a way. As, the first home that we had in Alameda was out in Harbor Bay Isle, a very, very well to do area of Alameda. And we lived there for 10 years, from 1986 uh, to 1996. And then in 1996, my second wife and I, we moved back to Oakland, and we purchased a condominium in the Grand Lake area, or actually it was uh, the Rose Garden area. So they're right up against each other, literally. But the Rose Garden is closer towards Piedmont, because literally we're only 3 blocks away from the Piedmont borderline, right there near the Rose Garden. So anyway, uh, and that's when my wife and I, we started looking at financial planners. I already had some people that I had already worked with, that I had interviewed, and I had various levels of comfort based upon the interview that I did with these financial planners. And the reason why I needed a financial planner was because of my work. And so I needed to outline and put in place tools and instruments, legal instruments, in the event that something happened to me, that the finances of my family would continue on uninterrupted. And also, uh, it was building a nest egg for the future. And because at one point, because of my work, I couldn't get life insurance because of my work. Um, it made it very difficult. And so it was uh, very late that my wife and I were able to get life insurance. And, and even with my high dangerous level of work, and term life insurance would not insure me because in the event, or my line of work was extremely dangerous and the likelihood of death and payment is highly likely. And so that's where whole life insurance comes in. And whole life insurance is very different than term insurance, and there's a lot of benefits in having whole life insurance. One of the biggest benefits is after 2 years of you putting into this whole life insurance policy, the, uh, number one of the first things I want to say is that there's a lot of different types of whole life insurance policies and different limits that they may or may not put onto the policy. But one of the main characteristics about a whole life insurance policy is the ability to borrow against the cash value of the policy at the time that you make the request. And so, uh, in my case, my second wife and I, we each had a $250,000 policy on each other, whole life insurance policy, which cost us $460 every month. It was automatically put into that whole life policy, and in the event of sudden demise of either one of us after the 2 year period, we were the survivor, the beneficiary, was guaranteed $250,000 payment in the event of death, and then in the event of an accidental death, it would pay out double that, so that it would be $500,000 in the event of a tragic accident. But what's the nice thing is that this whole time you're building cash value. That $460 isn't just thrown into the wind, so to speak, like with term insurance. Because with term insurance, you really are limited in what you can do with that insurance policy, and so that's why they're cheap. And I'll tell you a place where that cheap policy is an advantage, and it's only an advantage right in this one spot. So anyway, back to whole life. You can borrow against the cash value of the policy up to the $500,000 mark. Uh, but don't treat that like it's free money, because it's not free money. That's a death beneficiary or death benefit to pay off your home uh, if you die suddenly, and then also give your family, hopefully, a small financial cushion. Our condominium cost us $160,000 back in 1997. And in 1997, that wasn't that terribly bad of a price. $160,000, 2 bedroom, 2 bath condominium. It was on a top floor, older building. That's the only downside. It was one of the older buildings. It was a conversion from an apartment to condominiums. And so the condominium was an HOA, homeowner association. Very familiar with homeowner associations because I was a president for the homeowner association back in Alameda in my townhome association. And so very familiar with townhome cooperative living, so to speak. And going back to the whole life, um, one of the things that I want to say is that, number one, I'm not a financial expert. I'm not a financial planner. I'm not a financial strategist. I'm just letting you know this is what worked for me. And the person that I listened to a lot was also a very good friend, and I followed his advice pretty much to the letter, and it always worked out, and it still does today. But whole life um, insurance is one of your best hedges. It's better than a 401 because it's 100% safe. The reason why I say it's 100% safe, insurance companies are required by law and regulation to carry 80% of their all the value of their outstanding policies, meaning that they have to have that much in cash reserves, cash on hand, far more than that of your banks and credit unions, which require only a very, very small amount of that cash to be in reserve, to uh, consider that institution solvent. And that's what caused a lot of the problem back that stole all of my money. Insolvency. They didn't have enough cash reserves and to back up the deposits and the monies that were in their trust, and so a lot of that trust was blind. We were misinformed by those institutions. In fact, there were over 400 financial institutions going back nearly 200 years of operation it, when that happened. And one of the biggest ones was my main checking account. That was Washington Mutual, WAMU. They were the biggest bank failure in America. Uh, and I believe they are still holding that record uh, as being the number one. And they were my primary um, checking account, business accounts. I had credit lines with WAMU. I didn't have a home loan with WAMU. My home loan was through other agencies, non standard banking. So, but banks are not required to have the huge cash uh, on hand reserves like insurance companies. Even when Black Monday hit during the 1929 1930s, the crash, the stock market crash, the only business industry that was not impacted in any way whatsoever was the insurance companies. The insurance companies were never impacted by the downturn in the economy and the depression that lasted years. In fact, uh, the banks that had a lot of their uh, interests tied up in uh, insurance and in insurance policies, they were the ones that survived. Um, Bank of America was one of those, which originally started right here in San Francisco as the Bank of Italy. And then they became uh, the Bank of America uh, during the Depression. So, anyway, uh, my second wife and I, we took out a whole life insurance policy, $500,000, $250,000 on each of us, so a combined $500,000. And we had the beneficiary list laid out, which was her son and my stepson. And in the event that both of us were to suddenly die, and so this is part of estate planning because we don't know what's going to happen. And then nowadays, today, in this really crazy world, it's even more important to have a whole life insurance policy in place for those that are left behind, and also to cover your costs for funerals and arrangements. Because if it happens suddenly, believe me, most people aren't prepared to pay anywhere from $5,000 to $20,000 for a funeral and service, plus the real estate. Whether you buy a mausoleum or you buy dirt, uh, the lowest costs these days of for getting processing a body is cremation, and even that you're still looking at $2,500 for the cremation, and that's just handing you back a box. You don't have a niche. A niche can run you anywhere from $5,000 to another $10,000 Plus, then you have to have an earn. That special earn is going to run you anywhere from $1,500 to $8,000 for a bronze urn with all the information, the decedent's name, their birth year, and their death year. And even then, once you have that, then there's an opening and closing cost that the place charges. In my case, at Chapel of Chimes, it was $500 to remove 4 screws, take a piece of glass out, put my mother's urn inside that niche, put the glass back in there, put the 4 screws back in, and take the rolling cart, and off they go. $500. Yeah. And so those are the costs that uh, that insurance policy will cover. The and if you have that in place, I hope you do. And for those that do have their whole life insurance policies already in place, or even a term life insurance policy, you really want to go and save yourself some money and do some pre-need arrangements with uh, a cemetery, a mortuary in advance. Or if you don't want to do that in advance because you're uncomfortable with that, at least talk about it with a family planning and estate planning attorney. Uh, and that way, things can be put in place in the event of an emergency. But anyway, uh, the policy is not free money. That I want to make it very clear that this is not about free money. This is a very serious matter. Finances. Hopefully, you have a policy in place that covers the total cost of all the bills and the home in the event of your death or your spouse's death. So that insurance policy should be put in place. My dad put a life insurance policy in place back in 1990 and paid for it every month like clockwork. And his payment was $125 every month. And he passed away in 2011. So from 1990 to 2011, he paid $125 like clockwork. It came out of his checking account, and it can be that simple. If you get started later, um, it can be more expensive. We're like my second wife and I, uh, we started. Uh, I was in my 30s. She was in her 40s. You know, she was 10 years older than myself, and we had a lot of debt, and it was a struggle. But then one of the things that we were able to do after 2 years, we were able to borrow against that life insurance policy and pay off all of her student loans and pay back that loan that or what we borrowed against our life insurance at no interest and no penalties. And it didn't cost us anything in tax money because it wasn't any kind of capital gains. Where else can you be that a bank, your own bank like that, where you borrow from yourself, you pay back yourself, you don't charge interest to yourself because you already have a set cash value of $250,000. So that's how you establish the bank of you. And that's how you save money when you go to buy a home, when you need to go buy that car. You go borrow from your life insurance policy. And if you use that some of that money on your life insurance policy as an investment, as a second property, uh, as a rental, be very careful. Be very, very careful. taxes could come back and really hurt you on this. And if you're not able to pay back that loan or what you borrowed against your life insurance policy, if you're not able to pay that back, which you, in fact, you really don't have to. Uh, you can leave it outstanding, but the downside is that you diminish the overall value to your to the future heirs and the beneficiaries, and so that could jeopardize them paying off the primary home or the needs uh, of the time. And so it's not something that you want to gamble with. You don't want to use it frivolously. You want to use this very intelligently because there's a lot of tax savings in this, and there's a lot of money that you save by not paying those high interest rates to the banks or to a mortgage. You borrow from the bank of you. And the interesting thing is, you also do not need to have a home right now to have a whole life insurance policy. And so I encourage you to get a whole life insurance policy uh, in place of a 401, because a 401k and IRAs, there's some uh, small tax savings and benefits, but they're not safe. I can tell you that because I lost everything. I had a 401k when I was with a couple of different companies. I didn't really care about those 401ks because I was doing undercover work for the government um, when I was actually employed by these two companies, and they didn't know that I was actually gathering information on them. And so, anyway, that's why I didn't care about those 401ks. But when I left those companies, I took those 401k monies and I moved them out of 401 and IRAs and put them into the Bank of Me. And the other Bank of Me, the second path, was through real estate. I had a second property, and that was up in South Lake Tahoe, so it was well out of the area. It was considered our vacation home, our winter home. So, and we were with a group of people in that investment. So there were uh, 10 families in that, and we held on to that for 30 years. And so we did very well when we eventually sold it. And each one of us who were invested partner into that, we all and each had whole life insurance policies. And uh, those insurance policies specifically covered our portions, our shares of our commitment to that investment. And so that way it didn't jeopardize or risk anything for anybody else. It would automatically pay for it. So that's the importance of having whole life insurance policies, but also term life insurance policies. And here's where a term life insurance policy can be very beneficial to a senior or anybody who's 62 or over and is looking at a reverse mortgage. And here, by uh, taking out a term life insurance policy, number one, those are the cheapest insurance policies. And what you do, you take out a policy that is specifically to cover the reverse mortgage, the payback bill at the death of the homeowner. And so, um, with that policy in place, typically on the reverse mortgage, there's 45 to 90 days to pay back the reverse mortgage, what they call reverse mortgage loan. And that's what the insurance policy does, the term life insurance policy. You buy it specifically, slightly more than what is needed to pay off that reverse mortgage. That's the safest way to keep the home in the family if the intent is to keep the home. Some families opt to just let the home go. I know of a family who did that, and then the mother and father, they lived a couple of more years before they passed on, and they were shuffled all around quite a bit, which was sad to see that because they had developed so many memories and happy times where they were previously, and so uh, that's why I say if you do a reverse mortgage, um, be sure to put in place a term life insurance policy specifically enough to cover the reverse mortgage payback. And the reverse mortgage payback isn't just about the money that or that your loved ones, your mother, your father, grandparents, that they lived on and took all of the equity out of the home. But this policy puts back that uh, those monies and the interest that has accrued. And so that way, um, just signing some paper, submitting the death certificate, and then receiving the check. The check comes to the estate of or whoever was designated to receive those funds so that those funds can be forwarded and clear the title of that encumbrance. And so that's where term life insurance is good. Um, I I had my parents had New York Life. I'm not endorsing New York Life, but I'm just saying they were very ethical and they worked with me. The agent, my parents' agent, worked with me. He was their agent through the entire time from 1990 all the way through both my parents' passing. My mother passed away in 2001, then my dad passed away 10 years later in 2011. And so both times I dealt with the same life insurance agent, submitted all the different things, and he really did a good job. I can say that that agent did an extremely good job, a very efficient job, and he advised me of some things that came up that my crooked sister tried to do, and so we were able to thwart all of that and make sure that those didn't come to fruition. But one of the things that I really want to let you folks know that those of you who think your 401 and your IRAs are safe, they're not. I lost all of mine. I lost all of my investment, $3.25 million, all in liquid asset at the time. And I still had credit lines for substantially much more at the time. And I was able to get a specialized loan, which is called a collateralized debt obligation, a CDO, collateralized debt obligation. And these are special loans for people uh, who were like myself. I had the money, uh, and it was liquid and solvent. It was in a portfolio. They could see it. They can verify it. And so this type of loan is like for uh, people in the movie and the TV industry, senators, big name celebrities, where they're not always working, but when they do work, they make a tremendous amount of money and funds. And so uh, those loans are kind of those bridge loans that get them from one point to another point. In fact, the most uh, one of the worst cases that I ever saw of use of CDO was Michael Jackson, and he literally bankrupted a lot of organizations. because they were overvalued. He took out too much. They loaned too much, and so that's one of the downsides that of CDOs. The party who funds all of that is all at risk. And then also, if you lose your all your finances like I did, and they know it, you'll be receiving a notice uh, that they were going to repossess the home because you have no income and no means to pay for it. And it was going to take effect in 45 days. And that's pretty typical. And so um, but that's where I was at that time. And nobody, even yourselves out there, this was something I never disclosed, and those were things that were happening behind the scenes. It was horrible. Also, I had purchased an almost brand new 2007 Charger. It was when I moved there. It was 2007. I had the car for about 3 months, and it was repossessed by the bank, BB&T. I don't blame BB&T because I wasn't able to make the payments for 2 months. They came and got the car, and it was really sad because I had spoken to the branch manager right there in town, 20 minutes away. I said, "Look, um, car's up for repossession. I'm going to come in and bring you the key tomorrow morning. I'll be there before 10 o'clock with the key to hand you the key and the car. I'm going to drive the car there. I've arranged a ride so that I can get back home. So I'm going to leave the car and the key with you." But, yeah, they didn't see it that way and decided to pay repossess or whatever they paid, and they came and got the car in the middle of the night. How do I know? I heard it, and I looked out the window. I said, taking the car, screw it. I'm not going to go out there and fight anything. There's nothing to fight for, and so brought the key to BB&T in town the next morning and said goodbye, thanks. Yeah, and anyway, that was that. Uh, but you can borrow against a whole life insurance policy up to the $500,000 limit, of the policy. And so, but all the parties who are the undersigned signatures, the insured, both have to sign off on the loan papers, and the payback schedules and agreements. So a lot of these things, it takes both parties, and a lot of you folks say, well, if you had one of those, why didn't you borrow against yours? Well, because it takes two signatures. Both of us have to sign off on that. And since we were divorced and she was mad at me, um, she wouldn't sign off. In fact, it was a struggle to get my half uh, of some funds that was designated to by the court. The judge ordered this joint possession to be split equally, and so we sold it. And rather than her giving me my cut, which I was supposed to get, she kept it, and she, after a lot of yelling and threats, I did get a portion of it. Neither here nor there. That's it was just an ugly divorce towards the end. But anyway, I just want to let you know, 401ks, IRAs, those are suckers bets because you're not safe. They're not insured. They're they can be wiped out in the stock market overnight, and it has happened before. So you can't say that it'll never happen, that it can't be happened. They're not insured. They're not safe in any way, and it's up for loss. And so, and people have lost that, or they've drawn them out and spent them stupidly on either a car or vacation, and not paying back the sum that was loan, and so it affects the overall value at the end. But one of the nice things is that uh, you can take out a loan against that policy when you're in hospice, when you're in the final throes of your life. You can sign over a certain portion and be paid a portion so that you can deal or use it in any manner or fashion that you like, and it'll be deducted from the final payment to the beneficiaries. Uh, I know this is a tough subject for a lot of folks, but then it was also an extremely difficult topic for my dad to talk about. In fact, how he talked about it was that he didn't talk about it, and he refused to talk about it. And the more one would push him, the more angry he would get. So, folks, this is an important subject. No matter what your age is, it's important to put in place that foundation for your generational wealth of your loved ones, your children, your wife, and your future. This sets the foundation, and it's called whole life insurance. There's a lot of companies out there. Like I said, I personally have dealt with New York Life. Also, my mother, she had a life insurance policy through MetLife, through Macy's, and so we were able to collect a small policy from them. And MetLife was another very reputable organization. They worked with me very closely and paid out very quickly. So those are two companies that I have mass respect for, because they weren't trying to cheat me out of anything. They weren't trying to talk me out of doing anything, and they made sure that the beneficiaries received what they were entitled to. But this is part of a very important process. These days, we don't know what's going to happen. We can be walking down the street minding our own business, and then next thing you know, we're shot dead or run over in the street. So, again, thank you for joining me. This is an important topic. I hope you take it very seriously. This is how you create the bank of you and save thousands of dollars. And if you use it properly, you can purchase your home and pay back the loan at no interest, zero interest on that. And that saves you, over the course of 30 years, that saves you 3 times paying for your home 3 times over. Because if you took out a 30-year mortgage, doesn't matter what the interest rate is, you would have paid that amount. If you bought a $1 million home, by the time you finish making all 360 payments, you would have paid for your home 3 times over. And so that's a scary thought. That's why you want to cut your interest rates, no matter what it is. And by having a whole life insurance policy, I would encourage people these days to take out a $500,000 to $1 million policy in order to have the bank of you correctly funded and in place when you need it. Thanks for joining me today. We'll be right back.